Good morning from our global headquarters in New York City. I'm Danny Berger. Manish Cranny is out today. Welcome to Bloomberg Brief. Let's set your agenda. An 8-day rally halted. Stocks are now steady ahead of Fed minutes and revisions to jobs data. Walmart drops JD.com. Shares of the Chinese tech giant sink after Walmart sells its $3.6 billion stake. And the Obamas rally voters at the DNC, praising VP Harris and ripping into Trump. Well, the 8 days of a rally come to a stop. We're going a whole lot of nowhere this morning. Unchanged on your S&P 500 future session. The next catalyst, 10 a.m. today, we're going to get downward revisions likely to employment figures. Then we're going to get Fed minutes. But as Deutsche Bank Jim Reeds points out, that it's only revisions through March. It doesn't show the most recent data, so perhaps the Fed won't find it too consequential because they are judging the most recent labor market data. Your 10-year yield also a little change this morning after yesterday's rally across global bonds. It saw the 30-year yields drop to their lowest level year to date. Now, gold, that is taking a dip after trading at a record. So again, it's just a slight pause in some of the euphoria and assets that we've seen. It's still above 2,500 and the bullish calls are still there. David Rosenberg of Rosenberg Research says it is only a matter of time before gold hits $3,000 an ounce because of all the usual catalysts, central bank cuts from the Fed, central banks buying gold, concerns over the economy, and because bond markets are not the best of hedges, considering how volatile they are, and gold is under-owned despite all of that. Okay, now despite yesterday's slight declines, stocks have regained all the value that it lost and some over the past month. Chris Watling of Longview Economics writes this. Judging the end of a pullback is critical. As the market rallies into wave 2 of relief rally, it is tempting to get caught up in the improving mood and reinstate equity long overweight positions. Chris Watling, CEO and Chief Market Strategist of Longview Economics, joins us now. Chris, I know you did write that a week ago, and since then, equities have continued to rally. So is it your estimation that the sell-off still isn't over?
Well, I mean, the price action's clearly been pretty impressive in this rally. But yeah, I think there's a very good chance that there's some real downside risk ahead of us. If you look back overall at the price action of all sharp sell-offs, when you had the sort of first wave of selling, as we had in late July through to early August, if you look at all the examples of that over the last sort of few decades, there's about 15 really clear examples. And in 13 out of 15 instances, you rally in your wave 2 relief rally, as we've been doing for a couple of weeks, and then you go back and you retest those lows. So I have to admit, I mean, the relief rally's been very strong, and perhaps a little bit stronger than I expected. But I still think that's probably your main framework. And it's interesting to me, if you look at one or two other risk assets out there, you mentioned 30-year bond yields making new yield lows, or you look at 10-year bond yields, they're just above where they were on the 5th of August at that low point, or certainly with oil's been selling off. So quite a few other risk assets are starting to behave as if there may be a bit of downside from here. So I think the next 2 weeks is critical. Watch the price action. I think if it doesn't sell off, the best it'll do is go sideways and maybe have a couple of wobbles. But so I think one can get a very good perspective on that. But certainly, and 13 out of 15 times, you'd expect to pull back to the lows that we saw around August 5th.
Yeah, this disconnect between bond and equity markets, so many people have pointed it out, Chris, because bond markets are supposed to be the sanguine, the sobering view, but instead we've seen remarkable volatility in this bond market. What does it mean just for asset allocation to have bonds, as some people have put it, act like meme stocks, and really equities be a calm voice and just keep chugging along?
Well, it's a challenge because the sort of old 60-40 of equities and bonds, that sort of classic weighting that's meant to give you that ballast, as you say, with bonds giving you ballast when equities sell off. The correlation between bonds and equities keeps changing, and it's changed a number of times over the last couple of years, and changed again recently with bonds actually rallying in the sell-off into August the 5th as equities went down. So they were doing their job then. So I still think one should have that balance in a portfolio. It does have some hedging qualities, particularly if inflation's now beaten. It's when you've got an inflation problem that it doesn't work as a hedge. And I think inflation is beaten in the States. The economy's slowing, and therefore, bonds are back to doing their proper role and hedging against equities and risk assets as they sell off.
When it comes to hedges, I wonder what you make of David Rosenberg's view of Rosenberg Research that I just mentioned, this idea that gold has further to run because households have high allocations to equities and they need a hedge, and they don't trust bonds currently because of everything we're just talking to. So therefore, gold makes sense.
Well, I think gold makes sense because we're coming into a rate cutting cycle. And, we're going to start seeing some growth in money supply, which is basically, money creation as we look out 6, 12, 18 months. So, I like gold because I think it tends to do well in response to that. What I would say, though, is actually if I always like rule of thumb, most asset classes tend to rally for 2 to 3 years before they then had a sort of major give back for a year, 18 months. That's sort of a rough rule of thumb I like to keep an eye on. And of course, gold's been rallying since its lows in August 2020. So it's had a very long rally. It's done extremely well. It had a consolidation phase, and then it picked up that rally again earlier this year, back end of last year. So, there's a degree of tiredness to this rally. I think there's more to go for, but I'd say we're 80% of the way through, and we're gonna find as we get 6 months on. I guess what I'm saying is I wouldn't jump on hard on the gold trade. The best gains are behind us. There's probably still a bit more there, but it's limited in that once we started pricing in the rate cutting cycle, the sort of momentum behind it is going to slow.
Chris, just to take a step back, because you are a student of history in these markets as much as anything else. And it is in this moment, really the past year, that we've seen just this pendulum swinging back and forth between views of soft landing to hard landing to we're falling off a cliff to everything's okay to it's kind of slowing it. And you just see the volatility in asset classes in the meantime. What do you recommend to clients to do? Do you need to be more of a short-term trader to really capitalize off of some of these swinging views? Or is it you take a step back, you try to act sober, and you don't react to every market move?
I think that the key here is if you're an investor, which I would regard as someone with a sort of 6 month plus time frame, 6 months to 2 years or beyond, you want to use a volatility as an opportunity. Sure, if you're a trader, try and trade it, and we have short-term products that look to do that. But if you're an investor, you want to think about what's the next big global macro theme coming out there? What's going to drive markets on the next 1 to 4 year time frame? And I think the key here is the fact we're getting into rate cutting cycles across the West. That's key point number one. And key point number two is that the private sector in the US, the UK, and Southern Europe and lots of other bits of Europe has healed. Post-financial crisis, it was in a mess. Households were over indebted. The corporate sector was tricky. The banks weren't in good shape. All of that's gone. That's now healed. The pandemic sort of accelerated that healing. And they're now in very good shape. Just look at Eurozone household savings ratio. It's at its highest it's ever been, except for in the pandemic. So there's a lot of firepower out there that will respond to falling interest rates. And that is what should dictate how you invest when you get these bouts of volatility. Because I think over the next 1 to 4 years, the driver of the global stock market is going to change. It's not going to be the Mag 7 anymore. It's going to be much more classic cyclicals, more non-US equities as well, some mid and small cap US. So that's how I'd approach it if I was a long-term investor, which actually I suppose I am in a sense. But if you're a trader, of course, play the swings. But that's a totally different ballgame and a totally different set of tools to go about doing that.
Chris, well said. We'll leave it there. Chris Watling of Longview Economics, thank you for your time this morning. Okay, let's get you some other top stories that are trending on the terminal this morning. Now, after 2 days of search and rescue efforts, British tech entrepreneur Mike Lynch and Morgan Stanley International Chairman Jonathan Bloomer are feared dead. They and 4 others are expected by rescuers to still be aboard the sunken wreckage of a luxury yacht off the coast of Sicily following a storm. The Pentagon's intelligence agency said Ukraine and Russia both lack the military assets to mount major offensives against each other. The conclusion, the two are now headed for a stalemate, at least for now, despite Ukraine's incursion into Russian territory. And a federal judge has ruled that the FTC lacked authority to enforce its near total ban on non-compete agreements. The ban was set to go into effect next month. Now the FTC have the chance to appeal the ruling. The ban was an effort to make labor markets more competitive. Now, coming up on the show, Walmart ends its partnership with JD.com in China. We're going to talk about how Walmart is refining both its digital strategy and its strategy in the country. We're also going to look ahead to revisions in the payrolls data, what to expect later in the week from Jackson Hole. We'll catch up with Charles Schwab's Kathy Jones on your Bloomberg Brief this morning. It's your Wednesday edition of Bloomberg Brief. I'm Danny Berger in New York. Walmart is winding down its 8-year partnership with JD.com. In doing so, it's selling over 144 million shares of JD. That's about $3.6 billion worth. It is a change in strategy for Walmart in the world's second largest economy. Let's get over to Dasha Afanasieva on this. Dasha, what does it tell us about a strategy shift for Walmart?
So Walmart's not leaving China at all. It actually has a really strong business in China through Sam's Club, which is the hypermarket that works on membership operations, memberships. And that's actually, its China sales are growing double digit thanks to this format. Members pay and the incomes from that is growing something 26%, just the membership incomes. So people are just flocking to join this hypermarket. So when you compare that to JD.com's sales growth, it's just a lot more impressive. So it kind of makes sense that they'd want to deploy these billions in capital in their own business there rather than go for JD.com, particularly if you think about the backdrop of the weak Chinese consumer. Sam's Club only works so well because it's seen as such a good deal and a bargain, whereas JD.com is more of a proxy for the general strength of that confidence and buying power.
And Walmart, in talking about this, at least to Reuters, reflecting a lot of what you're saying, Dasha. The other thing I was interested in, they go through saying that they're going to focus on, as you say, Sam's Club in China, Walmart China, but also it helps them deploy capital towards other priorities. In this moment, Dasha, where we've been talking about the weakness of the consumer, yet Walmart comes out with these blockbuster earnings. What are the opportunities for Walmart right now? What are they growing? What are they focusing in on?
Well, from last week's results, what I found really interesting is the AI capability part. So a lot of companies are talking about AI, the opportunities in AI and how it's such a game changer and that they're doing stuff, but being very, very vague in terms of what they are actually doing, short of, having AI make adverts so you don't have to pay actors and stuff. And last week, Walmart said that AI helped it create or improve 850 million data points that then, help it predict the demand for its products. And that if humans had done this, then they would have needed 100 times as many people to do it, sort of to the same quality and in the same time frame. And I just found that fascinating because, really huge companies are challenged by, smaller players, and there's a lot more competition with the internet because you can find all these other suppliers. And I think what massive companies have to offer is this kind of investment that's going to make them more cost effective. Separately, I think that Walmart can deploy this capital in chasing the US consumer and kind of doubling down on the strategy of offering value, doing own brands, investing in creating white label products that then you're going to have both the wealthier consumers trade down to and you're going to have sort of the poorer end of the consumer that's really, really stretched at the moment is also going to be attractive to them.
Yeah, Dasha, I thought that AI part was really fascinating too. Without the use of generative AI, as you say, this work would have required nearly 100 times the current headcount to complete the same in the amount of time. That from their CEO on the call. Dasha, thank you so much. We'll catch up with you later in the show to get a look ahead to the earnings to come. Bloomberg's Dasha Afanasieva. Okay, let's get your quick check on markets this morning. Going a whole lot of nowhere. Equities slightly higher. They did snap 8 days of gains yesterday. Had they done 9, it would have been the longest winning streak since 2004, but we can put that statistic aside. The rally in bonds also takes a breather, as does the rally in gold, still above $2,500 an ounce. Okay, coming up, we're going to look at some of the headlines around the world, from politics to geopolitics. Blinken leaves the Middle East. This is Bloomberg. It's your Bloomberg Brief. I'm Danny Berger in New York. Let's get you some front page news, what's making headlines around the world. First up, on the New York Times, Biden approved a secret nuclear strategy refocusing on a Chinese threat. It's a classified document. Biden ordered U.S. forces to prepare for a possible coordination nuclear confrontation with Russia, China, and North Korea. The Pentagon thinks that China's stockpiles will rival the U.S. and Russia's over the next decade. Next up, The Guardian has this: ceasefire is elusive as Biden leaves the Middle East, as Blinken leaves the Middle East. The U.S. Secretary of State ended his 9th visit to the Middle East since October 7th without a truce. Of course, he had been saying that this was one of the last chances to get so. Blinken told reporters the deal needs to get done in the days ahead. And now front pages across the nation, let's be honest, they are displaying the face of former President Barack Obama and Michelle Obama after they energized the Democratic National Convention in Chicago last night. Here's what they had to say about both Harris and Trump.
We do not need 4 more years of bluster and bumbling and chaos.
A handful of votes in every precinct could decide the winner. There is no other choice than Kamala Harris and Tim Walz.
America's ready for a better story. We are ready for a president, Kamala Harris.
Joining us now is Bloomberg's Vonnie Quinn, up throughout the night in Washington, D.C., keeping a track of the DNC. Vonnie, great to talk to you. You had this energizing force from both of the Obamas, and not only did they lean on them in the DNC, in their speeches, but we also learned that Kamala Harris brought in veterans from Obama's campaign. Just talk to us about the strategy of really bringing the Obama camp in to the Harris camp.
Yes, a lot of coordination, actually, Danny. But when you think about it, David Plouffe, who ran the 2008 campaign, you also had Jen Palmieri, who was the former communications director through the Obama years, the person who was responsible for the battleground states. They have a track record. They have made sure that a person of colour got into the Oval Office. Nobody else in the country has done this. So there is the sense that perhaps they can do it again. Can they? Well, it's up for discussion. It has been quite some time since that all happened, but they do have that track record, and they will be going after the Obama coalition, the so-called coalition of voters, the multicultural, multi-religious, multi-ethnic group of voters that helped Obama get into the White House the first time round. There's also obviously a huge support from the Obamas that you saw tonight, and there is that urgency, a threat almost in the atmosphere. I just want to quote Michelle Obama, who spoke before Barack Obama. She said, "This is going to be an uphill battle. We need to vote in numbers that erase any doubt. We need to overwhelm any effort to suppress us." So this has been a thread that you've seen throughout the last several weeks. Kamala Harris has said it herself as well. Let's not get complacent. If we need to get more voters, then we need to be acting right now. We have less than 80 days. It's something like 77 days as of today. One of the rallying cries that Michelle Obama started up was, do something. So if you feel like complaining about something or complaining about how things are, we don't have time for that. Get on the phones, get the vote out, get people registered.
Yeah, finding purpose in your rage was the line that she used. Meanwhile, counter-programming, Vonnie, Donald Trump was speaking to Livingston County in Michigan, to share us the office there, saying that I am not a radical at all. I'm just a common sense person that was successful. This is kind of interesting, Vonnie, because they're trying to define Kamala Harris. Both are in a rush to do this. And here's Trump kind of talking about himself in this sense, saying that, you know, I'm not the weird person people are casting me as. I'm the common sense candidate. Where do we stand in this effort to define the candidates? Obviously, Trump is extremely well known, but time is running out as early voting starts in just a few weeks.
Yeah, I mean, this kind of comes out of the blue, doesn't it, Danny? It shows that he's been needled a little bit. I'm not sure anybody would consider Donald Trump a quote-unquote common sense candidate, not even his own supporters. I'm not sure that his supporters even want him to be a common sense candidate. It's clearly a response to this idea of weird being thrown around since Tim Walz debuted that word several weeks ago. It's really caught on, and it's circulating among Democratic leaders and all of the Democratic grassroots as well. Even Barack Obama tonight, he talked about Donald Trump's quote-unquote weird obsession with crowd size, and that was a line that went down very well at the United Center in Chicago. So yes, Trump definitely trying to rebrand himself. He's taking the advice, obviously, of elders in the party and his aides that he should play down the idea that he enjoys getting involved in culture wars and that he should go after policy. He can't help but try and come up with his own sort of insults for Kamala Harris, calling her a lunatic and making mention of her laugh and so on. And by the way, the second gentleman, Doug Emhoff, tonight said he loves Kamala Harris's laugh, and that was also a line that went down very well in the convention centre. So Donald Trump is continuing to counter-program. He's going to be in North Carolina, another very, very crucial swing state, on Wednesday, and Arizona on Thursday. And as we heard at the Democratic convention tonight, these are states that the Democrats are going to have to win big in order for there to be no question if they want to win the White House.
Yep, the swing state tour continues. Vonnie, thank you so much. Bloomberg's Vonnie Quinn. Okay, coming up, vanishing U.S. jobs. We are going to get the annual payrolls revision later today. We're going to look ahead to that in Jackson Hole with Kathy Jones of Charles Schwab on Bloomberg Brief. From our global headquarters in New York, welcome to Bloomberg Brief. I'm Danny Berger. Let's set your agenda. An 8-day rally halted. Stocks now steady ahead of Fed minutes and revisions to the jobs data. And Walmart drops JD.com, shares the tech giant sink after Walmart sells its $3.6 billion stake. And the Obamas rally voters at the DNC, praising VP Harris and ripping into Trump. So the 8 days did not turn into 9, and this morning markets going a whole lot of nowhere. S&P 500 futures, let's call them, and both the 10-year yield basically unchanged. The next potential catalyst we might get comes at 10 a.m. today, a downward revision to employment. But as Jim Reed from Deutsche Bank points out, it only goes through the March data. It does not have the most recent labor market data in it, so we'll need to judge its importance to the Fed based on that. Your 10-year yield, it is at 3.8%. There was a rally yesterday that sent 30-year yields to their lowest so far of the year. Reminder, we're also going to get Fed minutes today, but we've had a lot of Fed speak in the meantime since the last Fed meeting. Meanwhile, gold, that also takes a breather in its historic rally, down 0.2%, just above 2,500. It hit another all-time high yesterday. David Rosenberg of Rosenberg Research says that $3,000 an ounce is in view. Given the volatility in bond markets and an under-owned consumer and household to gold, it makes more sense as a hedge at this moment. Now, I mentioned it. The Fed's going to be releasing its annual revisions to the U.S. payroll data. That hits at 9 a.m. New York time. Let's get over to Bloomberg's Jill Desis for more on this. Jill, there seems to be a lot of debate around how much importance we should put on the revisions. So what are we likely to see, and how much attention should we actually be paying?
Well, Danny, yeah, I think as you just pointed out, this is really this is annual data that really just runs through March. So this doesn't really reflect any of the recent, labor market weakness or anything like that we've seen in some recent non-farms. So you can debate that, oh, well, it goes back to March. So really, I mean, it's not really that core recent jobs data that we're really looking at. That being said, Danny, I mean, what I think a lot of analysts are looking for is how weak that downward revision is ultimately going to be. This is, something that we normally see with this kind of data, but the revisions, the estimates are pretty vast. I mean, you've got Goldman Sachs estimating that it's a downward revision of something like 1 million in payrolls growth there. I think, you've got some others, JPM, that's suggesting maybe it's just 360,000. So some big variance there. I think, though, anything that this data tells us, Danny, is that if it's a pretty significantly large revision downward, maybe that suggests that actually some of that weakness in the labor market had its roots much earlier than more recently. And so maybe that's a bigger cause for concern for traders right now, particularly if they're thinking that the Fed isn't moving fast enough to cut interest rates. All of that is kind of what we may see in this data. And I would also just point out, Danny, that, I mean, Fed Chair Jay Powell has made this importance of jobs data. I mean, all data is important, but jobs data has really been really at the forefront of the Fed's focus right now. And I think just going into Jackson Hole, anything that suggests, again, like a really, really large revision could create a little bit of concern there.
And to that point, Jill, just talk about the concern and basically the fragility of the bond market going into this data point. Because we've seen, let's be honest, tier 2 data points, things that usually don't impact the bond market, do so in the past few weeks.
Yes, Danny, I mean, I think that at this point, look, there's a record amount of leverage in the bond market right now. I mean, we just released some analysis recently. I wrote it down saying, there's roughly $1.5 billion worth of risk riding on every basis point worth of yields right now. That's pretty crazy right now. This is obviously as, traders are betting on the Fed to cut interest rates. So I think that there's, that significance there that any kind of, big revision one way or the other can really sort of risk, creating, some volatility in markets here. I mean, as you mentioned, just a few weeks ago, the most recent set of jobs data that we had, there was quite a bit of fluctuation just within a minute there on, 10 or so basis points worth of fluctuations there. So I do think that as, people are waiting on some additional data, anything that's really going to give us some idea of where the Fed's standing as, we head into not just, this Jackson Hole conference, but also into the Fed meeting next month, that's going to be something that people are really, really paying attention to. We'll just have to see if this, likely downward revision is as big as, say, Goldman Sachs says it may be.
Jill, appreciate it. Bloomberg's Jill Desis there. And this just out from Paul Donovan of UBS talking about the revisions. This does not change anything about the economy. Making payrolls marginally less inaccurate is about spin, not substance. Well, when it comes to substance, we have been getting some Fed speak. Fed Governor Mickey Bowman was speaking yesterday. She said this: should the incoming data continue to show that inflation is moving sustainably towards our 2% goal, it will become appropriate to gradually lower the federal funds rate to prevent monetary policy from becoming overly restricted. Let's cross over to Kathy Jones, Chief Fixed Income Strategist at Charles Schwab. Kathy, we can talk about the jobs market revision in a moment, but I first want to touch on what Bowman said. That doesn't sound like someone that's ready to cut in September. That is a Bowman waiting for more data. What does it mean if Powell doesn't have unanimity heading into Jackson Hole and his ability to sound overly dovish?
Well, hi, Danny. I think that having Bowman even concede that it's possible that there could be rate cuts is probably a big move. She's been one of the sort of uber hawkish people at the Fed. I think he could probably get unanimity. I don't think he necessarily has to have it in order to get a rate cut in September or sound dovish at Jackson Hole coming up on Friday. There's enough other people at the Fed, such as Austin Goolsbee, Raphael Bostic, Mary Daly, all sort of indicating that, yeah, we're moving in the right direction, that inflation is pretty much at their target. So I'm sure for the first rate cut, the Fed would love to have unanimous consent on that. But if they don't have it, they can still move.
Well, part of the reason I'm interested in this idea of unanimity is because it's September. It's when people are already starting to vote. It is an election year. And Steve Rashudo of Mizuho puts it out basically saying that if they're going to cut into an election cycle, they need to have everyone in agreement. Are you saying that it's not really consideration of theirs?
Yeah, I don't think so. Again, this is a Fed that likes unanimous agreement, pretty much has had unanimous votes on every move that they've made over the last couple of years. So I'm sure that they want it. They don't need it. And I think in our minds, the election looms larger than it does for the Fed, just simply because they're quite aware of the long lags between their policy changes and what happens with the economy. So they really wanted to influence the election. It probably would have started 6 months ago or even earlier to have that impact. So I think that the election is not going to prevent them, or one vote is not going to prevent them from making a move if they think that that's appropriate.
Fair enough. I mean, look, there's a lot of things that we'd want to hear from Powell in the next couple days at Jackson Hole, Kathy. Whether or not he actually delivers them is another story. Putting aside, whether they're going to go 25 or 50, because we're unlikely to hear that. What do you want to hear from Jay Powell that would be helpful to understand as we near the start of the cutting cycle?
Well, there are many things I'd love to hear. I don't think that we'll hear them, many of them, but I'd love to hear a clear signal that, yes, we're ready to cut rates. That would put, September pretty much on the books. I think it's an overwhelming consensus that they'll cut 25 basis points in September. Would like to hear a very strong indication from Powell that, yes, that is the plan. He's probably not going to pre-commit too much more than maybe, yes, we're ready to start gradually lowering rates at upcoming meetings, but that would be enough to say, yeah, September seems very likely. Would love to hear more about the balance sheet because I think that it's going to be difficult for the Fed to continue to wind down the balance sheet in the next 6 months or so. I'd love to hear a little bit more consideration about how that's going to play into the calculus. I would also love to hear what Fed believes the neutral rate is right now. You know, there's been a lot of debate about this. I think it's very much up in the air. That would be very helpful, I think, for the market to price in longer duration bonds to say, where are we going long term with the neutral rate relative to where we're going with inflation? So those would be the big things, but I don't think we'll get precision and clarity that we're hoping for. We'll probably just get some strong hints.
I guess it's nice to have a wish list, even if none of it is likely to get ticked off, Kathy. I mean, you mentioned what we are likely to hear is what we've heard from other Fed speakers, the likes of Daly, of Goolsbee, of even Kashkari most recently, talking about gradualism, talking about a slower pace. Kathy, is this bond market that's pricing in still about 100 basis points of cuts so far this year and 200 looking out a year from now, is the bond market pricing in that offsides heading into a Jackson Hole where gradualism might be the theme?
Yeah, the bond market's been getting ahead of itself now for the last 2 years. So every time, because the Fed's data dependent, right? Every time we get a data point, the market tends to react to it and maybe overreact to it. And I think that we are pretty much pricing in as much of a cycle as is reasonable to expect. When you look at, you know, the 10-year at 380, that's fair value to us for this cycle. So they're well ahead of themselves. So certainly vulnerable to some surprises. And I think that's why we've gotten some of the volatility that we've seen in the last 6 months or so. Nonetheless, I do think that that's an accurate reflection of where we're going. It's just that we get there really fast. If Powell disappoints, yeah, we could get a backup in rates and get some more volatility. But it seems unlikely that he's going to stand there and deliver a hawkish message.
Given the ability of markets to overact, Kathy, how much do you care about the jobs data revision this morning?
Not too much. It will be interesting because we've had so much noise in the data, and the survey responses have been quite low. So there is a lot of concern that we're not getting an accurate view. If it's a substantial downward revision, that may tell us that the pace of job growth has been slower than expected and that the Fed maybe was misled by that. Or certainly miscalculated just how tight the job market has been. But it's pretty old data at this stage of the game, so it shouldn't have a major impact on the market.
Yep, they'll only show the revisions through March. Hey, Kathy, we really appreciate your time this morning. Kathy Jones of Charles Schwab. Coming up, Macy's and Target will report earnings before the bell. We're going to have more on another read, yet again, from the U.S. consumer this morning on Bloomberg Brief. Stay with us. Welcome back to Bloomberg Brief. Danny Berger here in New York. Okay, let's take a look at some of the couple of retail names. We're going to start off with Walmart and the announcement they made this morning. They are ending an 8-year partnership with JD.com in China. You can see shares of JD down 7.75%. The move, or rather 0.5%. The move led a broader sell-off in Chinese e-commerce and tech shares. Let's get more with Bloomberg's Subrat Patnaik. So, Subrat, why now? What is the strategy shift that Walmart is undergoing?
Morning, Danny. Yeah, it's a very interesting kind of move for Walmart to make at this juncture. But we've realized that they made an investment around 8 years ago, and things in the Chinese e-commerce market looked very different. We had Alibaba in the lead, then we had JD, and then PDD was kind of smaller. But with the advent of Temu, the entire landscape has kind of changed. So we have industry insiders telling us that basically Walmart might have picked the wrong horse in this race. It also opens up a lot of money for Walmart to invest in various other projects, Sam's Club, different geographies, different investments. So yeah, it's interesting in both ways, but yeah, it comes at a very interesting juncture.
Yeah, Walmart saying that it allows them to focus on strong China operations for Walmart China and Sam's Club and deploy capital towards other priorities. Subrat, how much of this is also just about Walmart's strength in technology and the lack of need for a partner to get some of their priorities done?
We've seen in the past that Walmart has made investment in other companies and trying to make it work. But when it comes to Walmart and tech, it's not been very successful in acquiring stakes or businesses and turning that around. So this is just one other example. So that is a little worrying when it comes to other Chinese names, and we've seen the sell-off. Just note that this morning the ADRs are not selling off as much as we saw the sell-off in Hong Kong. So it does seem to be more of a JD problem rather than a wider e-commerce China ADR problem at the moment.
Hey, Subrat, appreciate it. That is Bloomberg's Subrat Packnight. Okay, staying on retail, we're also going to get Target, Macy's, and TJX reporting before the bell. The results give us just another read on the U.S. consumer. Let's get back over to Bloomberg's Dasha Afanasieva. Dasha, companies more than ever are talking about the consumer this quarter, but they are squarely divided from strength and weakness. Walmart, as we were just discussing, being one of the ones seeing strength, expecting profits to expand. So in this next set of readings, what are you going to be looking out for?
Well, I think everyone's agreed that the consumer is stretched, but it's where different retailers position themselves that determines whether they weather that storm well or not. So if you look at Macy's, we're expecting a more cautious tone from the retailer, and I think the market really wants to see it focus on strategy, especially now that talks with Arc House and Brigade have ended. And in terms of TJ Maxx and Target, both of those are bargain names that, you know, giving consumers sort of this idea that they're getting a good deal. Target because it's quite cheap, TJX because it's got this range of sort of discounted designers and discounted branded products. So they might actually have an opportunity to strike a more positive note. Also because the second quarter last year was quite soft, so there's a better basis for comparison there.
We've also seen all this volatility in turnover of C-suite in consumer-facing brands. The most recent high-profile example, of course, Starbucks, but also Victoria's Secret having turnover too for their CEO. Is there a sense, Dasha, that strategy in a slowing environment is now more important than ever?
Yeah, I mean, if you look at the Starbucks share reaction to appointing the Chipotle CEO, rose 10%. So now consumer companies know that there's that option on the table if they want to get a positive share reaction. You know, you can look to Nike, which has had a lot of problems. So there's a lot of talk there. And I think that the strategy is key, and getting confidence, market confidence on your strategy, and in particular, the recognition that if it's so difficult to grow the top line, what are you going to be doing to boost the bottom line? What are you doing in terms of cost savings? What are you doing in terms of your headcount? What are you doing in terms of tech investment to make you more efficient, to justify having these massive companies? And I think that's what traders will be looking to. And it's not just the extreme of CEO turnover. You've got activists really live, really active in the sector. Nike, Starbucks, Reckitt, Bankiza in Europe. So CEOs should really be on alert, I think, and come in really confident in terms of how they're maneuvering in this quite challenging environment up until at least interest rates are cut.
A message of a warning from Bloomberg's Dasha Afanasieva. Play that for all the CEOs around the world. Dasha, thank you so much for all your work this morning. Okay, let's get a quick check on futures this morning, because they are not very changed unless you're looking at Russell 2000. In this recovery from this market, we are back where before we were on the July 31st rate decision. We've come back from that and plus some. Russell 2000 futures have outperformed the past 5 days. Russell is up 3.33% versus 2.5% for the S&P 500. The rotation trade is kind of coming back. Will Powell help that by signaling rate cuts, but an economy that's not falling apart? NASDAQ 100 futures, those are declining, perhaps underperforming because of Walmart selling their JD.com shares and those ADRs dropping precipitously. Okay, coming up, we're going to get you set up for your trading day on this Wednesday. We have some jobs data and minutes ahead. It's Bloomberg Brief. I'm Danny Berger in New York. Let's get you set up for your trading day ahead. We're going to get major retail earnings. We're going to hear from Target, Macy's, and TJX all before the bell. And then the Labor Department will be releasing revisions to their payroll data at 10 a.m. Eastern. Those show revisions up through till March, so it doesn't have most recent data. We're also going to get the latest Fed minutes. Those come out at 2 p.m. And then it will be day 3 of the DNC. It will feature Governor Tim Walz. Now, just a reminder, yesterday was a day of the Obamas. We heard from Michelle Obama and Barack Obama talking about unity and pushing forward, having this message of democracy under threat. Some of what we've heard from Biden. Let's just get a reminder of what we heard.
As any policy or program, I believe that's what we yearn for. A return to an America where we work together and look out for each other. A restoration of what Lincoln called, on the eve of Civil War, our bonds of affection. An America that taps what he called the better angels of our nature. That is what this election is about.
Meanwhile, Donald Trump was speaking in Livingston, saying, I'm not a radical at all. I'm just a common sense person that was successful. He was speaking to the sheriff's office in Michigan. Of note, also, Harris and Walz were in Milwaukee when the Obamas spoke. Of course, Walz, as I mentioned, will be in Chicago today, delivering the address for the DNC. Okay, let's look at some of the shares on the move this morning. JD.com, the ADRs are declining this morning. Walmart selling their stake, about $3.6 billion worth. Those shares down some 7.5%. Meanwhile, Keysight's Technology, they reported earnings, a really strong rally afterwards for the technology company, gaining some 12%. Meanwhile, it's pretty steady, pretty quiet in the rest of bond markets. How big of a catalyst will job market revisions be? There we are mixed. The thought is as if the revisions are large, it shows that perhaps there was some weakening in the labor market far sooner than we expected. But of course, it doesn't have the most recent data. So equity futures unchanged, except for Russell 2000. Small caps continue to outperform. Will this economy be able to thread the needle of allowing for rate cuts, but not falling off a cliff? A quick check on your bond market this morning. The rally taking a break. You saw the rally after Rick's bank cut, after weaker CPI data from Canada. So it was really a global rally. 30-year yields, though, yesterday fell to their lowest level of the year. Your 2-year yield just below 4%, 10-year yields at 3.8%, 30-year at 4.07. All right, that's it for Bloomberg Brief this morning. Surveillance, that's up ahead. It's a beautiful look of the blue moon.